Hello, hello. Welcome back. If you're new here, welcome. My name is Kristyn. I'm an authorized infinite banking practitioner, and I help Canadian families and business owners reclaim control over their money, create financial peace, and live the abundant lives that they were meant to live by keeping more of their hard-earned dollars working for them. So today we're going to kick off episode 2 of our summer series, where we're talking about financial lies that I used to believe that I no longer subscribe to. So today I think is going to be another big one, and I hear this so often. Almost every client that comes to me, this is something that they have struggled with, and it's that government has your best interests at heart. Now, I used to think that Canada was the best country in the entire world. I'm not going to get into politics, but I used to think that we had the perfect demographic system. We had a great democracy. We had government that was in place. It had great systems put in place to help the needy. Homelessness, all these other things weren't a big issue. And we had the best healthcare system in the whole world, and it was free. Now that I have kind of woken up to a lot of things that have been going on, I'm realizing that all government doesn't have the people's best interest at heart. Ultimately, they're working for the government. They're working for bigger powers at play. There's always money that's changing hands. There's, a ton of corrupt things that are happening, regardless of the country. This is happening everywhere. And so one of the things that I really used to think that I no longer think is that registered accounts were the best way to save. I thought that was the most tax efficient thing that I could do. I thought that really was the only tax shelter. And really, the only way that you could save for retirement was if I had an RRSP. Now, I guess fortunately or unfortunately, I didn't have a lot of money back when I used to think this. And so I really didn't have hardly anything into an RRSP. And so for that, I am thankful because I don't have to worry about withdrawing, being very strategic with how I withdraw. And it's not something that's so much on my radar now, where a lot of the clients that I have coming in, they're seeing the downside to these accounts that was never explained to them when they're accumulating. Because we have to remember, there's 2 phases to every retirement planning, right? We have the accumulation phase. This is the one that everybody's excited about. This is what every advisor is concerned about because they want to help you accumulate as much money as possible, right? Your financial advisor, whether it's at the bank or Edward Jones or, anywhere like that, they get paid based on how much cash you have sitting in their accounts. And so they want the more money in there, the better return they can give you. Of course, the more you're going to want to save with them, but the more of a return that you're getting, they're also getting a bigger piece of that. So the more money that they can help you collect, the better. And even better than that, we have these rules that the government put in place where this is basically kind of a tax shelter. You put cash into your RRSPs and it's not going to get taxed until, someday. So you can put cash in and it actually reduces your tax bill at the end of the year. And we've all seen this advertised. We see this advertised everywhere from your banks, again, to the boutique investment firms. As soon as tax season comes, man, once we hit like December, January, February, they are pushing to get those RRSPs, get you in as much as you possibly can to your limit. Again, because this is cash for them, it makes sense because they make a lot more money, obviously, the more cash under management. But more than that, they're advertising it to help you as the taxpayer, to help you pay less taxes today. And, the bigger refund you can get in a couple months, the better, right? That's what everyone's after. Everyone wants that quick return, the quick dollar, whatever. Now, there's a bit of a problem with that, though. And what they very seldom explain is that this isn't tax-free money. This isn't going to never get taxed. You're just kicking the tax can further down the road. When you're putting cash into these accounts, it's like putting a seed in the ground, okay? Now, that seed is going to grow. It's going to grow over time, right? You water it. Maybe you plant more seeds. The more cash you put into these accounts, the more seeds that you're planting, right? One day, you're going to want to reap a harvest. And let's imagine that we're planting trees, okay? One day, you're going to want to take the fruit off that tree and you're going to want to live off of that because at that point, we're in that decumulation phase. So this is phase 2, the one that often people don't talk about. This is the phase where you start to take cash out of these accounts. you're drawing it down. Now, again, remember that your advisor, and I'm not saying that they're all operating in bad faith or anything like that, but by design, the way that they get paid is by how much cash you have in these accounts. So again, it's to their benefit that they keep more cash in these accounts. But what they don't tell you is when you get to that phase that you have to start taking money out, that you're taxed on that money, on the withdrawal. And now you're not paying tax just on the cash that you put in. Now you're paying tax on that entire tree. So instead of paying tax on the seed before it's planted, before it grows, you're paying tax on every piece of fruit that you're pulling off that tree. Think about that. And we know taxes are due. You can't get around paying taxes. It's going to happen. But most people aren't looking far enough ahead to look and see, I'm going to need $100,000 to live on. They don't realize that the tax rates in the future, first of all, we don't know. And second of all, you don't know with inflation how much cash you're going to have to pull out. I can guarantee you're going to need more dollars in 20 years than you will today to live on at the same level. I don't know about you, but I don't want to decrease my standard of living when I hit retirement. Of course, I want to have my house paid off and I'm not going to have kids at home and all these other things. But guess what? I'm going to want to travel. I'm going to want to enjoy my retirement. So even though I'm not going to have maybe the same fixed bills, chances are I'm going to need more of that cash than I think when I hit that point. So part of the problem is that we have cash that's locked into these accounts now, and you are penalized through taxes every time you take a withdrawal. If you want to take out $100,000, you need to take out a lot more than that to be able to get the cash in hand that you need. So that's something that we really want to think about. It kind of reminds me of if you've ever seen National Lampoon's Christmas Vacation and we have Cousin Ed rolling in with his Winnebago and, it kind of reminds me of that. So if you are opening an RRSP, if you're putting yourself in this position, it's kind of like opening a business with Cousin Ed, right? Do we trust that he's not going to change the game on us? Do we trust that he's going to be financially responsible and not need to take more than what he's agreed to today? So in terms of taxes, I'm talking about, are we trusting that the government is not going to need more taxes in the future to fund the programs that they're promising today? If you look historically, taxes have gone up. How much more are they going to go up in the future years? How much more of your RRSP money is sitting there that is potentially going to get taxed at a much higher rate? And remember, you're the brackets, you're going to stay in a high income bracket. The promise is that you're going to be in a lower income tax bracket, so when you start withdrawing, you're not going to pay as much tax on it. There's a couple problems with that. First of all, if you are going to be in a lower tax bracket later on in retirement, first of all, that means that you're living at a lower standard, which I kind of touched on that already. I don't want to live like that. I'm sure you don't want to either. That's problem number one. Problem number two, it's going to take more dollars for you to be able to buy the same things 20 years from now as you're buying today. We have an unknown. The bigger unknown is that we don't know what taxes are going to be. Now, I haven't even touched on the bigger issue. So far, I've only talked about paying tax on either the seed before you plant it or the fruit as you're pulling it off the tree. Obviously, you're going to pay more tax on each piece of fruit than you would have on that seed, right? Because it's grown and to be so big. What happens when you pass away? Now you have this tree that's grown and it's producing all of this fruit. What happens to that? Well, if you're married, it's going to roll over to your spouse, so your spouse can enjoy it and they can, take out the fruit. They can enjoy the fruit, get taxed on the fruit. Maybe that was your intention and you're completely fine with the taxation of that, and that's fine. If that's your plan, great. The other problem, though, is when that second spouse passes away. Because most of us aren't told what happens to that account when both spouses are gone. So when both spouses are gone, this doesn't just turn into a non-registered investment and your kids maybe pay capital gains on it. It's actually taxed as income on your very last tax return. So when that second spouse passes away, let's say you had $1 million sitting in RRSPs, your spouse had $1 million sitting in RRSPs, you both pass away. Guess what? Now the government is going to take their cut as though that is income. You're going to be paying tax on that as though it was income, not gains. And your family will have that giant tax bill that they have to now do something with. So now that we're seeing these problems, I want to offer a couple solutions. And I am not, please don't get me wrong, I'm not saying that RRSPs are always bad. They're a terrible idea. If you have cash sitting in them, you should liquidate immediately. That is not what I'm saying. What I'm saying is that most people are not educated on every level of what happens. So we have our accumulation phase when you're paying in. Most people understand that. Your decumulation phase when you start taking out cash from that account. And then the final stage is your estate stage when this is going to be reconciled and all of the taxes are going to be paid out. I don't know about you, but I know I don't want the CRA to be my biggest beneficiary. I want whatever cash I have saved up to go directly to my kids. So let's talk about some solutions. My first advice, especially if you are in later years in retirement, would be just to have a life insurance policy in place to cover that tax liability so that more cash can come to your kids. That would be my first suggestion. Second of all, we want to be very strategic with how we're drawing cash out of these accounts. So I'm not saying take them, melt them down today, pay half in taxes. You would be taxed as income the same as if you passed away. I don't recommend doing that. What I do recommend is being really strategic and thinking ahead, starting when you're in your 50s, before you even get to that retirement point. I want you to really look at what you're going to need in your retirement, what kind of cash you're going to need sitting there. And especially, I can speak from experience, a lot of my clients are business owners. And we want to be even more strategic about how we're using this. If you have a down year, if you have a year where your revenue is really low, you don't have much income coming in, that would be a really great year to take out some cash from your RRSP when you have a lower income and put it into something else. You could put it into a non-registered account. So often you can have it invested in the same way, just not as part of the RRSP. So it would still be the same investments, same income that you would see in that, so the same growth, but it would be taxed differently. And you would be taxed going forward on, an annual basis or however those investments are taxed, but you wouldn't have to worry about the estate problem down in the future. So that's something that you want to consider, especially if you have a substantial RRSP. If you think you're going to outlive your cash, that's something that I would suggest. And then often what I see with clients that are coming to me, they're looking for help. They want to get cash out of their registered accounts, even some of it, the stuff that they know that they're not going to use in their lifetime. We start moving some of those investments out. And we put them into a properly designed whole life insurance policy. We know that's what I do. I do infinite banking. And when we're using it in this way, we're using it to, one, preserve the estate. We want to make sure that the cash is going to stay there for the kids. It'll go directly to the kids without taxation, without going through probate, anything like that. It stays completely private, and it bypasses all of the other things that can take, months or even years to settle everything. The life insurance benefits are settled within, a matter of a week or days. So it's really beneficial for the family in terms of an estate planning tool. It's also interesting because if we compare the returns that you get inside of a participating whole life insurance policy, I can't call it an investment because it's not, but the returns are very comparable and often higher than they are inside of a bond portfolio. And if that's something that you're interested in, I would encourage you to book a call with me. We can sit down. I can actually show you comparisons of historical bonds, even comparisons to the S&P 500. We can look at how these policies perform compared to the historical data that we have. And you'll see that there's a lot less standard deviation, so a lot less fluctuations from one year to the next, which is amazing. But more importantly than all of that is we don't have those dips in the market. So we know that once you get in retirement age, you can't afford to have the market crash. You can't afford to have those dips that we saw in recent years in 2007. Around that point, there were all these dips that happened, and anyone that was approaching retirement or very close to it, or even was in retirement and really loving all of the really high returns, all of a sudden their stocks tanked and they lost about half. And when you're in retirement and you're in that decumulation phase and you're taking the cash out, you're locking in those losses when you have to take it out. So that's something that we get to avoid when we're using something like this and we're keeping it. We're still taking advantage of tax. I can call it tax deferrability, because there are things that you can do inside of an insurance policy, ways that you can access cash that would trigger tax. But I help my clients and I teach them how to access their cash without triggering any taxes. There's lots of ways that this can be done. And ultimately to preserve that estate so that more of it can go towards your kids. So if that's something that you are interested in, I encourage you to check out my free training below. And there's a link down below if you want to book a call to start. Your future self will thank you. Until next time, live free.